Hello, welcome back to Topic Tuesday with Alan Dembski and Juliana Jansen. We have a great topic today on target date funds. What everyone wants to hear about this time of year. As the year is coming to an end, your retirement date's going to change. Hopefully, you get a year closer. But again, these videos are purely for informational purposes and are not intended to be investment advice or financial advice. Seek guidance for your specific situation. I'm going to turn it over to Juliana to get us started today.
Yeah, so we often get asked about target date funds, particularly for people that are participating in employer retirement accounts. They're very popular in employer retirement accounts. And, clients often ask, are they the right decision for them? And like with anything, not just in finance, but in life, is the answer is it depends. It can definitely be a good option for in some instances. So first off, what is a target date fund? Basically, a target date fund is an investment vehicle that bundles stocks and bonds together and fixed income investments um, into an allocation that's based on an estimate of when you're going to retire.
Yeah, so a target date fund offers simplicity. So investors just pick a fund based on their target retirement year. So like if I'm 30 years old and by the time I hit 65, how many years is that? That's 25 years. So this is 2025. My retirement default would be 2060. So the fund company actually handles that allocation, would be probably pretty aggressive. You're probably 80-20 or 90-10%, 90% of the stock market. As far as the allocation there, if you have that much time frame, the older you get, the more conservative that would be. But it lacks customization. So if you have a proper investment portfolio or options in your retirement plan, sometimes it's better to build your own if you want to do that. But again, the simplicity is a very good option for a lot of investors. Just pick the date and let the investment company handle that for you.
Yeah, and another pro is that the investment company will automatically rebalance for you. So as you start moving closer to retirement, the amount of stock exposure is going to go down and the amount of fixed income exposure is going to go up. So life gets busy. People don't necessarily want to spend time looking at or thinking about their 401ks, their 403bs. And this is a nice way to accomplish those balances without really having to think about it. The con there is when you don't get involved in it and you don't look into it, you don't really know what the timeline is that specific fund company is making those adjustments on. So, somebody might be bringing you closer to a larger fixed income and percentage quicker or not as quick, depending on their own company methodologies. And there is quite a bit of difference from company to company. So that's one of the negatives.
Yeah, and the investment companies are reviewing and managing this by their teams. And they're diversified across different asset classes, whether it's domestic, international equities, domestic bonds versus international bonds. So there's a lot of movements. And like you said, every company doesn't think the same when it comes to allocation. I mean, our major partners, every time we're on conference calls, they say some things that are similar, but their views are different in a lot of different areas. So, a pro is that you have large investment companies like the Vanguard State Streets of the world that are managing these for you. But with that management, you get higher costs. They tend to be a little bit higher in fees inside a retirement plan. And again, every company rebalances differently too. So if you have a Vanguard fund versus a State Street, Vanguard might rebalance quarterly. One might be semi-annual, one might be 2 years, one might be 3 years. And that's at the mercy of having those investment companies manage your risk.
Yeah, so target date funds can be good for beginning investors that don't have a deep knowledge of investing. However, one of the cons outside of the additional cost that you just talked about might be that you might be taking on more or less risk than you really want to because you don't have you're not getting into the nitty gritty of what they're investing in. So, just depends on what your investing style is, what your level of interest in terms of your investing. But what I will say is for a younger investor, getting into a target date fund can definitely be a better option than going super safe. We have clients that come in that they're in their 60s and their whole life they've been extremely conservative, and we just don't see the growth that other equity investors see if you're only investing in fixed rate. So that's the other side of getting involved in target date funds. It's definitely better than going super safe.
Yeah, and lastly, I think it does reduce emotional trading, where people might make bad decisions, during market downturns, or they might get too aggressive during bull markets, like people tend to do. They tend to flood. The opposite of what you should do. We buy high and sell low instead of the opposite there. But when you're taking that emotional trading out, the con is that you don't have any control. So the investment companies are doing that. You're not picking how much you want to allocate to domestic, international, and bonds. You're actually leaving that to the professionals, which isn't necessarily a bad thing. But I think in summary here, what we've been talking about, when looking at target date, understand or take a look at what's under the hood, because not all target dates are created equal, and every company is not created equal. So just because you may have heard or did some research, again, I'm not using Vanguard. Again, this is not picking on it. I'm just using names for reference. Vanguard versus American funds. Take a look at what they're investing in underneath those target date funds. It don't take you a few minutes, and you don't have to be investment savvy to take a look at these funds and say, yeah, that looks like something I want to do.
Along
Going
with the
forward,
cost, along with assessing the
along with the
cost.
cost, yeah. And sometimes you don't have control over that because your employer is picking that fund lineup. However, you can still manage costs inside of 401k depending on how the investments are allocated. Anything you care to share at the end as we close here for our target date fund video?
I think that's a good start.
Awesome. Well, join us next time. Follow us on all our social media, whether it's YouTube, Facebook, Twitter. We are out and about, and hopefully you got something out of this video. If there's a topic you want us to discuss, drop a comment and we'll add it to the list. Thank you very much, and we'll talk to you soon.